Financial statements are the end product of the process for recording transactions of a company. The transactions of a company relate to operating, financing, and investment activities of the business. The topic of financial reporting mechanics covers the process of recording the business transactions of a company. Specifically, we will cover the classification of business activities for financial reporting, the classification of financial statement elements and accounts, accounting equation and the process of recording business transaction, and the flow of information in an accounting system. And finally, we will learn about accruals and valuation adjustments in the preparation of financial statements. Business activities are of three types: operating activities, investing activities, and financing activities. Operating activities are the day-to-day routine activities of the business. These are essential activities that require to be carried out on a day-to-day basis, such as selling goods and services, which leads to the generation of revenue of the business, incurring expenses such as transportation costs, utility bills, etc. in the process of generating those revenues. Investing activities are those activities that are associated with the acquisition and disposal of long-term assets. For example, buying assets such as land or building or plant, or selling machinery, vehicles, etc. Financing activities relate to obtaining or repaying capital of the business. For example, borrowing money from creditors or banks that leads to the creation of liability, and selling share or ownership interest of the company, which results in equity capital of the shareholders or the owners of the business. Similarly, buying back of shares and paying back loan are also financing activities. Note that while describing the business activities, we have been able to identify the financial statements element. For example, the income statement or profit and loss account comprises of revenue items and expenses. Similarly, the balance sheet is comprised of assets, liabilities, and equity. We can develop an understanding of the different business activities from the profit and loss account and the balance sheet. In the profit and loss account, we start with sales and we deduct from it the cost of goods sold. We get gross profit, and from this we deduct operating expenses, so we get operating income. And when we deduct interest expenses, we get the earning before taxes. If we deduct taxes from it, we get earning after taxes or net income. So we see that in the profit and loss account, we have revenues and then we have expenses. On the balance sheet, we have assets and we have liabilities and equities. In assets, we have current assets and we have long-term assets. Liabilities, we have current liabilities and we have long-term liabilities. And in equity, we have paid up capital and we also have retained earnings. Current assets and current liabilities are also considered as operating activities, and therefore the total operating activities of the business represents all items that affect the income statement or the profit and loss account, as well as the current assets and the current liabilities of the business. On the other hand, investing activities represent actions or activities that affect long-term assets, either increasing or decreasing them. Financing activities, on the other hand, represents actions or activities that affect the long-term liabilities or the equity of the business. However, there are differences across businesses. For example, interest received by a bank is considered operating activity. On the other hand, interest received by a non-financial company, that is a trading or a manufacturing company, may be classified as an operating or an investing activity. All financial statements are composed of 5 elements or types of accounts, as you may know it from your financial accounting module. Assets are economic resources owned by the company. Each asset has potential economic benefit which is expected to be received by the company over time. Assets include current assets such as inventory, cash, and long-term assets such as plant, machinery, land, and building. Assets may be tangible or intangible, such as goodwill or patents or trademarks. Liabilities are what the company owes to creditors, that is, the creditor's claims on the resources, that is, the assets of a company. These include current liabilities such as trade payables and long-term liabilities such as bank loan, bonds, etc. Owner's equity represents the residual claim on the resources of the company. Again, resources here refers to assets. So, at any point of time, the assets minus liabilities of a business are equal to the owner's equity, and in the company we call it shareholders' capital or shareholders' equity. Revenue represents inflows of economic resources to the company. It can be in the form of sales, gains, as well as investment income. In other words, revenues represent increases in assets that are not the result of transactions with the suppliers of capital, that is creditors and shareholders. As per the IFRS, the term income includes both revenues and gains. However, there is a difference. Revenue refers to inflows of economic resources that are from the primary business activities, while gains represents inflows of economic resources that are from secondary or peripheral business activities. For example, Apple generates revenue from selling iPhone, which is its primary activity. However, if Apple generates any income from selling old equipment above its book value, it will be considered again as selling old equipment is not its primary activity. Contrary to revenue, expenses represents outflows of economic resources from the business, or in other words, represents increases in the liabilities of the business. Alternatively, expenses represent goods and services consumed in the process of generating revenue. IFRS identifies these 5 elements of financial statements. However, under the US GAAP, financial statement elements include assets, liabilities, owner's equity, revenue, expenses, gains, and losses. Throughout this module, however, we will be using the classification as per the IFRS. We will be aggregating gains and revenues into one, that is a revenue, and losses and expenses will be aggregated into expenses. Losses and expenses are alike with a subtle difference. Expenses arise from the primary activities of the business, while losses arise from secondary activities of the business. Loss may be shown as part of operating activities or non-operating activities. For example, the loss due to decline in value of inventory will be part of the operating activities. However, the loss on the sale of non-trading investments will be reported as non-operating activity. An account is a classified record of transactions. For financial statements, amounts are recorded in every individual account and are summarized and grouped appropriately within the financial statement elements such as assets, liabilities, and equity, or revenue and expenses. For example, in the case of assets, we have accounts that are grouped and summarized as cash and cash equivalents, accounts receivables or trade receivables, prepaid expenses, inventory, property, plant and equipment, investment property, intangible assets such as patents, trademarks, licenses, copyright, goodwill, etc., financial assets such as trading securities and investment securities. Liability accounts include accounts or trade payables, debt or loan payable, bonds payable, accrued expenses, or advance income. An asset of one business may be a liability for another. For example, when a bank lends a loan to a borrower, the bank creates an asset, which is a loan receivable. On the other hand, the borrower has to pay back the loan and hence has a loan liability. Similarly, selling goods on credit to customer creates accounts receivable, which is an asset for a business, and creates account payable for the customer. Equity accounts include capital or common stock account, additional paid in capital or share premium, retained earnings, and accumulated other comprehensive income. Capital or common stock represents the shares that have been issued to the shareholders of the company. The additional paid in capital represents the amount that is received over and above the par value of the stock. Retained earnings represents the earnings that have been retained in the business over years. Accumulated other comprehensive income include changes in the value of assets or liabilities that are not reflected in the income statement and have been carried over time. Here we have an excerpt from Apple's annual report which contains the shareholders' equity of Apple for the year 2011 compared to 2010, and it has three account. One is the common stock account, which represents the number of shares that have been issued to the shareholders, and then the second one is retained earnings, and finally there are accumulated other comprehensive income or losses. The total shareholders equity is the sum of all these three items in the shareholders equity. Revenue accounts are reported in the profit and loss account or income statement and include revenue or sales account, different gains account, and investment income account such as interest income or dividends income. Expenses account that are there in the profit and loss account or income statement include cost of goods sold, selling, general and administrative expenses such as rent, utilities, salaries, advertising expenses, depreciation and amortization, interest expense, tax expenses, and losses.